Hello, everyone. So nice to see all of you again. And we are back with doing what we like best, and that is discussing newer concepts in strategic business leadership every day. Today, we'll be discussing corporate reporting in great detail. Uh, See, this is something, which is not just accounting or financial reporting, but something which is changing the way reporting is happening on a global level. So the topic is when I say corporate reporting, it's not just all about numbers. In the older days, it was all about balance sheet and P&L and statement of cash flows and, statement of changes in shareholders' equity and all of that. But today the world is different. The world is changing. Today, your investors, your regulators, your society, they are all asking deeper questions. They are asking a different set of questions today. What are their questions now? What impact does this company have on the environment? How responsibly does it treat its employees and communities? Is it compassionate? Does it give equal opportunities to men and women and to people belonging to different cultures, genders, religion, and all of that? Is it does it have a strong anti-discrimination policy? Is it governed in an ethical and transparent way? So, this is where sustainability, modern day sustainability, and integrated reporting come in. Today, what we are going to do is we are going to break down the concepts connect it with some Indian and global examples and understand how to apply these in your SBL exam. Now, the evolution of corporate accounting basically comes from an understanding that now your corporate reporting is not just talking about one single dimension, which is financial performance. You cannot only worry about profits and dividends or market share, but your vision has to be a 360-degree round vision. It cannot just be pinpointed or laser focused on one area. And just looking at financial numbers is not enough. Businesses are being held accountable for much more: their environmental footprint, their social responsibility, their governance quality, and how they create long term shareholder value. Okay, so all of these are activities on which they are being judged. And in India, for example, Infosys publishes a detailed ESG report every year. I'll show that to you towards the end of today's discussion. I'll also show you a report that Starbucks prepares or has prepared in the past, where you don't talk just about revenue and profit, but also about carbon reduction, employee diversity, CSR activities. Companies like Unilever on the global scale are pioneers in sustainability reporting, showing how their brands contribute to health, nutrition, and the environment. In your exam, the shift is critical. It's not just about shareholders, it's about all the stakeholders. And that is where, the vision of corporate reporting today is very different as compared to what it was earlier. It focuses on complete disclosure, it focuses on making sure that all relevant information that the individuals, all the stakeholders need to know is made available to them at the right time in the manner that helps them to make better and more informed decisions. In your modern day, what do your corporate reports look like? They are not just financial statements. Financial statements are important, but they are just one important component out of many. We are talking about integrated reports, sustainability reports, environmental reports, and governance reports. Integrated reports combine financial and non financial data to show how the business creates value over time. Mahindra Group in India, for example, publishes integrated reports aligned with global frameworks, showcasing how they balance profit with sustainability. Sustainability reports are what they focus on: ESG, environmental, social, and governance impacts. Tata Steel, for example, issues a very detailed sustainability report which highlights what efforts are they making in reducing emissions and improving the overall safety of the workers. On the other hand, environmental reports are laser focused. Okay, they will focus on how you are trying to reduce the carbon footprint, or how you are economizing the use of water, how exactly are you dealing with climate risk. And it will, in certain cases, because these reports are made and the public is consuming it, the stakeholders are consuming and using these reports, you might get a separate assurance activity also done, which of course is discussed in more detail in AAA. And then there are governance reports which cover board structures, executive pay. Executive pay means the amount of salary that you are paying to the executive directors of the company, the risk management policies that the company has in place, and all of that. I mean, HDFC Bank, by the way, publishes a governance disclosure to reassure investors about their internal control and ethical conduct. Now, see, the approach is, these days it's less of, in older days, how it was, there was a penalty associated with everything, and everything was made mandatory. Today also everything is mandatory, but the focus is more on, self-assessment, or self-understanding and making voluntary disclosures instead of having, somebody enforce it and shove it down your throat. Like for example, something like the Companies Act, compliance with IFRS, compliance with, say, SEBI's listing requirements in India, or the Sarbanes-Oxley Act in the UK. These are all mandatory. You don't get a choice here. But voluntary disclosure means, as responsible corporate citizens, they expect you to talk about sustainability performance metrics. They expect you to talk about strategic outlook and future plans. They expect you to discuss how the stakeholder engagement is taking place. So all of these are expected out of you, so that, and that responsibility is put solely on you. You are expected to be self-aware. You are expected to understand what your stakeholders need and then provide them that kind of information. Let me show you what the Starbucks ESG report looks like. This report talks about the global environmental and social impact, where they are talking about people, planet, and governance. Let me take you to one part of this report where they are talking about the opportunities, how they are uplifting their partners, and then they are presenting some statistics. Let me take you to that part. Okay, so here, what they are trying to say is they are trying to talk about the inclusion and diversity at workplace. So basically, they have given a report on, how in your senior leadership roles, what is the percentage, what is the female representation, or do you have members from, they use a term called BIPOC, which is basically for Black and Indigenous people of color. So you and I, we Indians and Southeast Asians, and we fall into the people of color category because they are whites, and then there are African Americans, and we are all people of color for that matter for them. So are you giving equal opportunities to everyone? How much is the proportion of women? How much is the proportion of women of color, men of color, member from LGBTQ community? Do you have global equity in pay? Because pay parity has become a very significant, excuse me, pay parity has become a very significant point of discussion. And these reports go on to highlight how the company has pioneered an equal pay for equal work, and that kind of inclusion and diversity at workplace. And see this report, now you see this flag, this is the pride flag. So they are trying to include, they are trying to give equal opportunities for those individuals who belong to the LGBTQ community, or people with certain hearing disabilities, or visually impaired people. So we are talking about that. So this is how corporate reporting now is. It's not only talking about profit or interest coverage ratio or balance sheet. There are so many newer aspects, that we are introducing here. And these are voluntary disclosures that they expect you to make. Now, what impact do stakeholders have on reporting measures? Is there a relationship? So, see, why are companies under pressure to report more? Because now stakeholders are demanding it. They are rightfully so asking these questions. Customers want to know if the products are ethically sourced. Indian consumers are looking for brands like Fab India or Forest Essentials, which emphasize sustainability. Now think about it. If you get to know that the product that you are consuming was made using child labor, naturally, you would not want to buy products from such a company. So today, customers are asking for these questions. Stakeholders are asking these questions. Institutional investors, for example, they demand long-term strategy disclosures. I mean, BlackRock, the world's largest asset management company has publicly insisted companies to show climate risk strategies. And climate change is a real phenomena. Contrary to what Donald Trump says that, this is a made up thought or whatever, other people say climate change is real and institutional investors sometimes might demand it, right? And the society at large might expect certain disclosures. For example, the Vedanta Sterlite controversy in Tamil Nadu, this highlighted the consequence of poor environmental reporting, and then the society demanded that certain disclosures should be made. For example, if I were to think of a situation where people get to know that in fireworks factory at Sivakasi, there are children who are employed to, actually manufacture or make crackers. Naturally, the world view about that company will change and people will no longer buy their products. We live in a world of cancel culture, right? One incorrect sentiment or, one incorrect thought and it all goes down the drain just like that. So it's critical that you know how these things are impacting you, and you should be ready to tackle anything that comes out of it. You will have to preempt, you will have to understand what the world expects, what kind of disclosures do they need, and you will have to rise up, you will have to step up to the occasion to make sure that before the world holds you responsible for something, you have already found a solution to tackle that particular problem and you are reporting on it in the manner that is expected out of you. Now, I would want to talk about Apple's supplier code of conduct. Even IKEA has one, by the way. And what does the code of conduct say? Supplier shall accurately record information regarding its business activities, labor, health and safety, and environmental practices, and shall disclose such information without falsification or misrepresentation to all the parties. Are you employing children at work? Do you provide safety gear to people who are working? Uh, do you have a hygienic work environment? Is it safe for everyone to operate in? So all of these questions, I mean, Apple as a company expects its suppliers and everybody down the supply chain to basically have answers to. And if at some point in time it requires that, if it comes to a realization that somebody who is manufacturing chips for the company is doing it in an unethical manner, maybe by doing some sort of child labor, or by including unethically sourced material and so on, then naturally Apple would not want to associate itself with such a company, because tomorrow when people get to know, they will boycott Apple, or the sales of Apple will get impacted, which is why Apple only wants to work with those suppliers who fulfill these basic requirements that Apple has from its customers, suppliers, basically. Not customers, basically everyone in the supply chain needs to be ethically responsible when they are producing and shipping items. The global reporting initiative that we are talking about, it's basically a different approach on understanding what are some of those additional disclosures, maybe not necessarily compulsory disclosures, but what are some of those additional points that individuals and companies who are in the business world need to report to the world outside. And this, right now, you would not necessarily call them mandatory. You would call them recommendatory in nature. But the point is that somewhere the way the world perceives depends upon the disclosures and transparency that you are making, which is why more emphasis is there on the Global Reporting Initiative. The GRI is an international independent organization encouraging detailed sustainability reporting. It publishes sustainability reporting standards designed for preparing comprehensive sustainability reports. Now, what exactly is the Global Reporting Initiative? See, it basically is an organization which is a voluntary setup, but which gives a framework to report on energy, water, emissions, and human rights. For example, Wipro in India uses global reporting standards for its sustainability related disclosures. Now, see, it's right now sustainability related disclosures are not mandatory in the same way financial reporting related disclosures are, but we are trying to move towards that world wherein uh, these universal, wherein sustainability reporting becomes as much a critical part of the corporate reporting objectives. See, the Global Reporting Initiative has certain universal standards which need to be applied by everyone. And then there are topic specific standards, like, for example, how do you make disclosures relating to human rights, or with respect to energy conservation, water management, greenhouse gas emissions. You do discuss all of these points, and these are topic specific. Now, the idea behind sustainability reporting is that you're not only talking about profits anymore, you're talking about people, planet, and profits, right? So it's the triple bottom line approach which is slowly and surely coming into existence. The task force on climate related disclosures, it focuses on climate related risks, and banks like HSBC, Indian firms like ICICI Bank, companies, they are using these TCFD guidelines to show climate change impacts on the financial risk. Like, you have the International Accounting Standards Board, you also have the International Sustainability Standards Board, and now they are coming up with International Sustainability Reporting Standards, which slowly are becoming a part of mainstream corporate disclosures, which focus on greenhouse gas emissions, pollution, measures, risks, and how do you tackle the risks that are coming into the business. Now, with that in mind, let's understand the evolution of sustainability reporting. Earlier, we started with the triple bottom line, where you said that it's not just profit, but focus on people and planets. Then the International Integrated Reporting Council issued a framework for more concise, holistic view of organizational performance. The task force on climate related financial disclosures. See, this task force, this group of this voluntary group focused on developing a set of uniform disclosure requirements when it came to climate change related activities. And that made sure that whatever impact the climate change was having on assets, on financial risk, on overall business risk, on its ability to generate returns, so on and so forth, all of that slowly and surely has started becoming a part of the disclosures. The International Sustainability Standards Board is it's again, like IASB, you have ISSB, and right now they have released two sustainability reporting standards, IFRS S1 and S2, which give you detailed comprehensive guidance on how to report on sustainability, pollution, greenhouse gas emission, so on and so forth. Okay, now let's turn our attention to what I would say is the hot topic right now, which is integrated reporting. Integrate means to bring something together. And let's understand now, what is it that integrated reporting is trying to bring together. Let's talk about integrated reporting. As I said, to integrate is to bring together. But what are we bringing together and why are we doing it? It is a concise communication about how an organization's strategy, governance, performance, and prospects in the context of its external environment lead to the creation of value over short, medium, and long term. Up sounds so heavy, right? It's not just another report, it's a mindset. It's a complete shift in mindset in how organizations are functioning. What are they doing? How are they impacting the environment? Are they adding value to the environment? Are they adding value to the world around them? Is the world adding value to them? That is what we are trying to understand in integrated reporting. It may be a standalone document, it's a single document, but it has links with everything that the company is doing. And let's dive deeper into how that happens. Now, what are the goals of integrated reporting? When I talk of goals of integrated reporting, it's what are we trying to achieve? We are trying to produce, we are basically trying to provide better information of conveying more with less. Basically, giving details in terms of, again, having a transparent approach to disclosures and ensuring that everybody who has provided something to the company, and by provided, I mean The investors have given money to the company. The employees are giving their services to the company. The society at large has given a space to the company to operate in, and the organization is operating in a way with tacit approval and permission from the society. So each of these people have provided something to the company. What are you providing them in return? It's a two-way street, right? The reporting approach is expected to be far more cohesive. Basically, do not comment on aspects, in a disjoint manner. Comment on it together. To give you a simple example, an organization has basically, it is causing pollution, or, because of the changes in the environment, there is a higher proportion of CO2 in the atmosphere. And because of that, the overall quality of life in that particular area is declining. People in Delhi will be able to relate with it. Because see, when pollution happens, all of us here in Delhi NCR, we have to wear masks, and our health also declines, and we face respiratory issues. So the pollution has an impact on people. And then what are the steps that you are trying to reduce the pollution? Are you doing tree plantation? Are you treating greenhouse gases before they are released? What are you doing? That is a cohesive reporting approach. So you're not only talking about the fact that yes, this is the output, but creating this particular output led to this much pollution, and these are the steps that we are doing in order to reduce the pollution. It is basically enhancing capital accountability. When I say capital accountability, capital here means any resource, not just money. Okay. So employees are giving their time, investors have given money, society has given permission. There is human capital, intellectual capital, financial capital, natural capital. So something has been provided to you to get a job done. How are you respond? What are you giving them in return? This is basically what the capital accountability is all about. Then we are talking about interdependency understanding. So promote understanding of relationships amongst various capitals and their combined effect on value creation. We'll see what various types of capital are, and then integrated decision making. Support integrated thinking in decisions. So do not look at items in isolation, but you will have to, again, as I'm using the word 360-degree view, do not just think about the output that you are producing and the wealth you are generating, but also analyze the impact on the environment in short, medium, and long term. What steps are you trying to mitigate that impact? How exactly are you trying to improve performance? All of that is basically discussed together. It's not just a sustainability report. It's not just a financial report. It's not just a multi stakeholder focused report. It's all of that and much more, which you will see very, very soon what that is. In the in context of integrated reporting, we have the six capital framework. Financial capital, which is the money that is, pumped into the business, which can be obtained from investors, from lenders, from banks, from everyone. Then you have the natural capital, environmental resources and processes supporting organizational prosperity over time. Like, you have your factory right next to a river and you are harnessing the water resources from there. That is natural capital. Social and relationship capital is institutions, relationships, and networks that enhance individual and collective well being. So, when I'm talking about social and relationship capital, what relationship do you have with the very society whose permission, tacit permission, you have taken for setting up your business there? What are you trying to return to the society, and what kind of a relationship you have built with them over time? Manufactured capital is physical objects like building, equipment, and infrastructure distinct from natural objects. So, manufactured capital is machinery, plant, those man-made items which basically help you to produce the final output. Then you have the intellectual capital, which is organization-based intangibles, including patents, processes, and systems. So, your documented standard operating procedures, your internal documents which guide how customer service has to be done. That is something, the organization has done over a long time, and it is perfected with time. That is intellectual capital. And human capital is the competency of individuals, their capabilities, what they uniquely bring to the table, and how do you improve that? That is your human capital. And all these six capitals work together to give you a certain final output. Okay. All these six capitals, what do I mean? They work together. You cannot expect that only the funding will help you achieve your organizational objective, or only the intellectual knowledge base will help you to achieve the organizational objective. All of these have to work together to help the organization reach its ultimate goal, right? And see, organizations, when you say create value, that value is not always, an appreciation in share price. That value is people who have given these resources to the entity, people who are, connected with the entity in different way. How are you adding to their knowledge base about the company? Are you giving them information which helps them understand the overall perspective about the company, what the organization is doing, what are the pitfalls, what are the challenges, what are the growth parameters, what damage is it causing to the world around it? So when I talk about all of these aspects in the report, it basically gives me more detailed information, and it helps the stakeholders perceive organization in the right capacity, understanding how they are also impacted by the organization, because we are not just people who are running after profits, but we are people who basically care for other things also. Now, when it comes to integrated reporting, there are certain guiding principles that we need to keep in mind. For example, there are six or seven basic principles you need to hold dear: strategic focus and future orientation. So it's not just giving information, but tying it with the long term goals of the organization, and making sure that the information is interconnected. For example, a pollution control equipment that you have purchased will be shown in the balance sheet under non current assets. It will also be a part of the sustainability report. It will also be a part of, the integrated report, which now is trying to correlate the actual pollution control equipment with the cash flows, with the actual damage caused to the environment, with the CO2 emissions, with what steps you are taking to reduce that. So all of these are now tied up together. Then stakeholder relationships provide insights into nature and quality of relationships with the stakeholders. Who are your stakeholders? In what proportion do they matter? Why do they matter? And how are you trying to tackle the relationship with them? Do you, and here, Mendelow's matrix will come into picture. How are you trying to deal with each individual set of stakeholders? Again, all of the items that you disclose should basically be viewed from the lens of materiality. Only that information which helps you in long term value creation should be focused upon. Again, nobody is interested in reading 50,000 pages of information. The information has to be concise. The information has to be complete, and it has to be gathered in such a way and presented with corroborative points so that it increases the overall reliability. Not to forget, the consistency and comparability of information is equally critical. The integrated report consists of 8 elements: the organizational overview, the history of the organization, the current organization structure, who reports to whom, what does the organization do, what are the circumstances it operates under. Then, how does the governance structure support value creation over time? By governance structure, we are talking about the corporate governance aspects here. So what are we basically trying to emphasize on? We are trying to say that, if the organization has set up it has set up, a remuneration committee, an audit committee, a nomination committee, and it has whistleblowing mechanisms, and it has an ethics helpline. It is doing all of these, and how exactly is it contributing to value creation? How were you able to reduce the incidence of unethical activities because of this? How did whistleblowing help? That is what the governance structure supporting value creation over time means. What is your model for value? What is your business model? How do you earn incomes? Where do you spend the money? What are the risks and opportunities that affect the ability to create value? How do you allocate resources? How much resources do you have? How do you decide which projects get the resources, which projects don't? Do you calculate the profitability index? Do you calculate the NPV? Do you calculate the returns from the project? How do you decide how the allocation of resources is done? Then, to what extent has the organization achieved its strategic performance related objectives? Say, for example, it wanted to increase its revenue from 100 to 200, or it wanted to reduce the greenhouse gas emissions in order to achieve a net zero carbon position by so and so year. So, out of those objectives, which ones have you achieved and how exactly have you been able to achieve those? Then, so again, report on that. What challenges and uncertainties do you think you will encounter, and what is the basis of information that has been presented in the financial reports? Now, when you prepare the integrated report, see, the stakeholders understand the links with financial performance, that when this much revenue is produced, this is the greenhouse gas emission, and they understand the impact of their consumption. It gives a deeper insight to the stakeholders. The stakeholders understand where they stand with respect to the entity, and it gives a complete idea of how what is happening in the company, and where does it stand right now, where does it want to go, and an understanding of the environment in which you are operating. But there are a lot of implementation challenges because A, there is no legal requirement. The framework lacks specific KPI or measurement methods. And that itself could be a bigger problem, right? When you don't know how to measure, then application of that becomes difficult, right? There are comparability issues because there is no standard structure of how an integrated report has to be prepared, and companies often fear that disclosing certain information might be too much. They might give away their competitive edge, and these reports often don't provide additional information. It shouldn't become just a piece of report which is filled with a lot of information and words, but not really communicating anything worthwhile to the individuals. And when I'm talking about integrated reports, naturally, when you report on something, and see, this is a report that the company prepares. Now, if the company wants the world at large to rely on these reports, then they will have to get these integrated reports audited. And see, the job of an auditor is only to comment on the financial statements. Now, if you are putting this additional responsibility on the auditor, A, there is no specific framework that has been given. Like for auditing financial statements, you have IFRS, right? But for auditing integrated reports, right now, there is no established set of standards. Some of the information is backward looking, some of the information is forward looking, and it becomes very difficult to comment on that. In a lot of cases, organizations might make use of ISA 720, which is basically, auditor's responsibility to report on other information, but that is simply not adequate. So these challenges still continue. And in the next part of this discussion, we'll be looking at some integrated reports, and we'll dive further into sustainability reporting.